Let's start the real reason why the stock market is a psychological game. Number one is that it's unpredictable. The stock market is unpredictable in a sense that we do not have the necessary technology to predict the best possible outcome on where it goes. It is a proof that market volatility is an inevitable part of investing. The shorter time as possible you engage on a trade, the more it gets confusing and unpredictable. Yet the longer you envision a company to develop and grow, the greater your chance to predict profitability because companies are designed to grow onto the market depending on their good tracking record. A certain company entering the stock has millions of data to be calculated because of the different factors that may affect its ups and downs, such as profits, dividends, GDP numbers, new technology, viruses, war, speculation, fear, and a lot more, which the current computing technology do not have the best prediction model as it may goes. The term volatility enters the game, and because of its unpredictable fluctuation, human psychology also function onto the game. Confirmation bias would always mix inside the game, and even the best trader in short-term game can lose it all despite having the necessary skills, thus unable to combat the unpredictability of the game. Number 2 is that ego and emotions are fundamental. The best example is the one I've elaborated before, as human decision making are purely controlled by 80% emotion and only 20% of their logic. Usually, there are only two best losers on that game. They are the one who has all the knowledge and experience towards the stock market game, and the other one would be the newbie or beginners. Both persons are affected by ego and emotion, as knowledgeable investors with complete analysis strongly believe they can predict the outcome due to their speculation still end up losing after a while. On the other hand, the inexperienced just follow the trend until the trend collapses and they are left hanging to lose all their money after a while. Being arrogant is knowledgeable and confident upon something, and it is usually the trait of people who knew everything. Arrogance and ego go hand in hand, and in the stock market that favors the discipline to control the psychological emotion of the game, the genius, arrogant, egoistic investor always lose the game. Traders who are more patient and disciplined around their strategy would still have the success in the long run, but they are still bound to be affected by ego and emotion at the end of the trading game. Number 3 is that buy low, sell high creates speculative volatility. This is actually the basic foundation of trading. Everyone wants to profit and to benefit onto their game. This is the reason why people are attracted to buy when the price is low. Then vice versa is that the seller is also attracted to sell when the price is high. Products and services are exposed to demand and supply reaction. The pandemic is an example where the price of a simple face mask had tripled because its demand was being reacted by the consumer, making the seller in a profitable position. On the other hand, as smartphone technology that was outpaced by other technology downgrade its price due to competition, making the buyer benefit to that situation. In the stock market, you can study how a company can go low and enable you to grab the opportunity to buy when it is low. Investors are part of the grand scheme how stock market become much more complicated. Reality would tell us that buying low and selling high is part of a psychological skills for a trader. Number 4, following the majority would put you to 90 to 95% people who lose their money in stock market or being stuck in a bad investment. Instinct would tell us that we flock on things that majority would go. Everything that goes viral, we seek, we copy, and we join to the band. The fear of missing out or the herd mentality becomes a human anxiety, where most of us behave socially and that by missing things where others had gone on to, we felt some regret that we had not joined their experience along. In stock market, majority of the people are stuck on following what the masses had told them so. During the boom of cryptocurrency, last 2017, Many are aware that it is something different as it goes up to become a trending topic in a way that people had joined to its full hype in the market until finally the bubble popped and majority had experienced a tremendous loss to their capital. Following the majority is a hype example that we are scared of missing this kind of opportunity, and our emotion would tell us that we should invest until it's too late. We set aside our priority up until we already begin to gamble on that reward. In stock market, 90 to 95% people lose the game because of such mindset that would not separate their strategy from the crowd. It is probably a good investment, but later on, when things gone wrong, we become stupid for a while and was left hanging to that bad investment we thought to be good in the first place. As famous investors quoted that to be wise in the market game, be fearful when others are greedy, and be greedy when others are fearful. As the current stock investment are already surrounded by minded and experienced people, the opposite of majority are being reversed. Warren Buffett quoted such phrase, many investors are already adopting such investment culture. Thus, 80 to 90% of the people invested are already aware on such quote trend. So the result was that they still end up being in the majority who are broke and losers. I'd say that in the current trend, why not reverse Warren quotes that be fearful when others are fearful and greedy when others are greedy? Because at the end of the day, you still can tame the actual unpredictability of the game. Number 5 is that it's very hard to be in the 5 to 10% who are successful. As traders are more focused to winning big and compete to each other into the battleground when the market opens up until it closes. Those who manage to make profit can assume that they are already successful, while those who made losses would dare to beat the game again. The top 5 to 10% are successful because they are being consistent on making profit while reluctant to lose their game. It is very easy to lose in the game but very difficult to gain success, as it only accounts to the top 5 to 10% investors. If you win on a 5 consistent days, you can lose all of it just in a single day if you lose that ability to compete to the top 5 to 10%. Consistency is the key if you really want to master the psychology of the market, and that requires your discipline and anticipation of the game. Last but not the least is the number 6. You can be successful without much having the knowledge, while can also be a massive loser even if you do have the most understanding of the game. While it is true that knowledge and experience bring us the success, it doesn't really have the application when it comes to the stock market. Every people who just started can win the game and become successful only if they had given the luck that was not given to the experienced investor. Making big bets in the game can propel you above among the rest even if you don't have the knowledge, as long as you had anticipate your vision toward the company you bet. Being knowledgeable doesn't grant you to an automatic wealth. In fact, majority of the well-knowledgeable and experienced investor lose much just because they thought they knew everything. Quotes: when people follow their natural instinct, they tend to apply faulty reasoning to investing. So I made this video to share some insight to every upcoming investors who are willing to gamble onto the stock market. Engaging on stock market can be a risky bet, but if you are there just to learn and explore how the game works, I recommend you to start investing first on preferred local countries such as the Philippines. Thank you for supporting this channel again. See you soon on to my other next video.